I had planned to cover some updates on my portfolio, but with Jerome Powell blowing up the market, and as I'm currently fighting the flu, no COVID! I figured I'd make a short video on this and what I'm doing to protect my investments. Here we go. The Jackson Hole Symposium, as it's formerly known, has been organised by the US Fed since 1982 for bankers, economists and policymakers from now 70 countries to meet and discuss world economics and strategies. And fly fishing. Last year, Powell had a somewhat positive stance with the expectation that inflation was transitory and a soft landing was possible, but in reality inflation has persisted. Market tensions have been high due to the anticipation of what Jerome Powell might say, with the expectation of a more hawkish stance, meaning more aggressive actions in the near future to bring inflation down. Incredibly, in just an 8-minute speech, Powell laid down the law. The Fed is using the lessons of past inflations to build current policy. Essentially, failing to deal with high inflation now will prolong the impact and result in having to take more extreme actions later down the road to avoid a recession. The way Powell has put it, you can have the pain now, or you can have more pain later. Powell intends to take forceful, rapid steps to bring inflation back under control, doing whatever it takes to get the job done. Looking at the technicals, rates are up by 2.25% since March, consumer inflation peaked at 9.1% in June, far above the 6.5% the central bank wanted, and as much as inflation has come down faster than expected to 8.5% in July, 1 month is not enough to justify easing back, and Powell has made it clear that he wants to see a massive amount of data that supports a soft landing before he makes any changes to the strategy. As you know, the result of all this aggressive talk has dealt some severe punishment to the stock market, or what I'm going to be calling Pownishment. With a sell-off seeing the Dow fall over 1,000 points, or 3%, the S&P down by 3.4%, and the tech-heavy Nasdaq down by almost 4%, making it the worst day on the market since March 2020. And of course, big tech took the most punishment, with Meta down by 4.2%, Amazon 4.8%, Microsoft 3.7%, Apple 3.8%, Sales 5%, Nvidia 9.3%. Although I can't say I'm surprised about Salesforce or Nvidia given their reported earnings. It's a result of these media heavy stocks being driven too high by their brand appeal and not to the fundamentals. Idiot stocks! And this is the inevitable result. It's somewhat ridiculous that investors reacted this way, as Powell has been dishing out the punishment for some time, paving the way for further rate hikes in the future, and it's clear from the talk of the town that few expected them to pivot on their stance.
Pivot.
Pivot. Pivot point.
Pivot.
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 Pivot. Pivot.
Pivot.
Dovish pivot. It's the stupidest thing on earth.
Pivot! Shut up! Shut up! Shut up!
With the Fed's agenda quite clear, I've been playing bear market for some time by not throwing more money into the market, but rather than taking money out, I've been using leverage to boost my cash positions. I took out a short position on Nvidia just before they declared a miss on earnings, and although the stock initially went up on the day, highlighting the illogical way the company is traded, it put me in a very good position for Friday's announcement. What we're seeing, in my opinion, are moves from investors who are desperate to own a piece of big brand growth companies regardless of their fundamentals, because they want to ride the next bull run, or hedge fund managers who need a portion of their funds in popular companies to appease their clients. But the market is trading ridiculously high, with the S&P PE ratio at 31.2, it's 55% above the average of 19.6, with the Nasdaq in particular trading just close to 27 times. A Fed announcement is there to remind us that stocks have become expensive, and you need to be careful what you own right now. If you go by the basic measure that the PE number represents a number of years to make your money back, do you want to be owning stocks that are trading over 50 times earnings as we walk into a recession? Effectively, if that corrects down to 25 times, for example, you have to hold twice as long to make your money back. It was fine when you thought these companies had tons of growth on the way, but that's not the case when companies are now seeing slower demand, increased costs, and reduced operating leverage. What really gets my back up is YouTube influencers using clickbait market crash video thumbnails to pull views to give you generic useless insights, or going on about Tesla as a long-term play despite its overvaluation, or this dogmatic approach to keep investing no matter what, always buy the dip. I take a more pragmatic approach to this channel and how I do my investing, and my stance is this: the honeymoon is over. The Fed are going to be as aggressive as they need to be to get the job done, and the sooner you accept this, the sooner you can build a more defensive strategy. So rather than give you some 10-minute rant, here's something actionable. In fact, I'm going to give you 3. Firstly, I'm going to avoid buying this particular dip because it's too broad and justified by the Fed's agenda and overall market conditions, especially when September is typically a bad month for equities, and I would usually be cutting back and raising my cash position now rather than buying more. Good companies will find a long-term support level, and it's best to determine where this is and for rates to stabilise before throwing more money into the market.
It's like throwing money down the toilet.
If you do happen to own any of these big overbought companies, you might see a chance to sell slightly higher as novice, short-sighted investors buy the dip, thinking stocks are going to go straight back up. So take advantage of their ignorance, but hold on longer at your peril. Having avoided overvalued and unprofitable names, I've barely been affected by this particular drop, and there just isn't anything in my portfolio I want to sell right now. But have a look for yourself and check out my channel for coverage on these companies in particular if you want my individual opinion. Secondly, as I've explained before, markets can come down just as much as up, and there are alternative strategies to make money from a downturn, depending on where you trade, namely options or leverage funds. For example, if you are genuinely holding a long position in Nvidia and don't want to sell despite the downturn, consider a strangle position, using leverage against your equities to offset their short-term losses and enhance your position. A simple 3 times inverse leverage position would take this drop and give you 3 times back, put it in cash which you can then use to buy more equities, even the same one at a reduced price. My US viewers have the benefit of options trading and access to higher leverage positions that amplify this strategy further, but I remain firmly against CFDs, and I would urge you to be selective in which companies you short, as the high level of dip buying and meme mania on the market can punish even the most justified strategies. If you get the opportunity to make a fast and quick profit on your position, don't be greedy. When you have a win, take your profits off the table before someone else does. Third and last, the issues of rising energy costs are becoming a major concern to companies and households, and you just can't ignore this. Winter is coming, and largely thanks to Putin restricting and now burning off gas supplies, Germany have failed to build up their gas reserves in time, and with warnings of energy bills across Europe rising by up to 80%, the EU are trying to impose a price cap, whilst the UK have set up their energy bill support scheme, which includes a £400 bills discount. The threat is real, and that's why I've been leveraging natural gas prices and seeing some massive returns already, turning a negative outlook into a positive return on investment. Energy prices can be somewhat volatile, but there's plenty of overall upside if you get in early enough. I said I would keep this short, so I'm going to leave it there, but as always, if you have any thoughts, please comment below and let me know. And if you like what you see and you want to see more, remember to smash that like button and subscribe. Until next time.